Morning, everyone. Hope everyone's keeping well. Ahead of a big price increase next week. So there's quite a lot going on. We need to talk about. Obviously, developments in Iran are top of mind. So we're going to chat about that and the implications I guess, for South Africa. The first major implication is the diesel and petrol price increase. And then what that does to inflation, what that might do to interest rates. The Reserve Bank meets on interest rates today. If I go back a month, our expectation was that the Reserve Bank would be cutting interest rates today. The inflation numbers, I'll show you in a little while, the inflation numbers in South Africa have actually been very good. So we were certainly on track for at least one, probably two interest rate cuts this year. That was before the Iran war. But with developments in Iran, the oil price, that's all gone away. The Reserve Bank will keep rates on hold and then warn us, highlight that if this conflict continues on for an extended period, then we may well get interest rate increases. So all of that has changed. At the moment, we're looking at a price shock around the world, but I see in Australia more than 500 fuel stations, petrol stations have run out of fuel. So in some parts of Asia, there are reports of fuel shortages. And obviously, if you go from a price shock into a supply shock, it does change the dynamic for your economy. So that's something we need to be mindful of. At this stage, we're not overly concerned about a supply shock in South Africa. We get most of our oil from Nigeria, the rest of Africa, and I think we've procured a fair bit of supply. But clearly, we can get ourselves into difficulty if this thing carries on for an extended period. So what I'm going to do is I'm going to put up some charts as usual. We're going to focus initially on the US. I just want to give you a sense of how the US is doing and what obviously the oil price and so on will mean for them. And then we'll turn to South Africa. There's good news. It's not all bad news. There is some good news on South Africa, mainly around private-public partnerships developing much better. So we've been talking about, for ages, we've been talking about the need for private-public partnerships, but fortunately, there's now evidence of those being put in place. And I remain very hopeful that we'll see further evidence and we'll see a positive impact of those partnerships. I'll explain that as we get to that. So there are some good pieces of news, if you like, but we're not going to be able to get away from this big petrol price adjustment. So let me just put up the charts. There will be some time at the end, I hope, for some questions. I do tend to speak a little bit, so I need to watch the time. And I don't want to steal Rico's time because he's got important stuff to tell us.
Yes, Kevin, sorry, just on that, I just want to remind the audience that if they've got any questions, they please feel free to post it in the Q&A section, and we will answer those questions for you. Thank you.
Thanks, Corné. Okay, so I'm hoping you can see the charts. Let's start with the US. The US economy is doing okay-ish. Their growth rate is not as good as it has been. Certainly, it has slowed down relative to when Biden was president. Not that he did a fantastic job, but the growth rate is not as strong as it was in the preceding, let's say, 3 or 4 years. And the growth rate this year equally will not be quite as good. It doesn't mean that there's a risk at this stage of a recession. That's not what we're talking about. And we're not talking about any global recession. There's nothing like that that's been discussed. What we are talking about is some slowdown in economic activity because of the Iran crisis, but it tends to cause much more of a concern about inflation than a concern about growth, certainly in the initial stage. Obviously, if the Iran crisis carries on, and now we're into months and years, then it will impact growth more substantially. But at this stage, the bigger concern is What does this do to the inflation dynamics around the world? So why is the US growth rate not as good as it's been? And it's got a hell of a lot to do with a slowdown in labor market conditions, or a softening of labor market conditions. So on the screen, I've just got a chart of how many jobs are added every month in the United States. And in preceding years, ignore 21 because that's a recovery from COVID. But if you look 2023, 24, there were no job losses in any of the months, and they were adding jobs typically at about 120, 150,000 jobs a month. So you can imagine if you've already got a very high level of employment, your unemployment rate is below 4%. So your labor market is already doing exceptionally well. And then on top of that, you add 120, 150,000 jobs, then clearly your economy is going to be incredibly vibrant. And that was what the US was enjoying at the time. Alongside of that, there were other significant benefits, particularly household wealth at an all-time record high, house prices at a record high, stock market doing exceptionally well. There were lots of positives that were accompanying that. But if you look in the last, let's say the last 14 months, certainly since Trump was elected, the labor market has not been as robust. There have been a couple of months where there's been declines. And even in the months where they've added jobs, the number of jobs being added have not been nearly as robust as previously. So now you're looking at an average of about 10 to 15,000 jobs a month. That's significantly lower than an average of 120,000. So what's caused this weakness in terms of the US labor market? And a lot of it has to do with the Liberation Day tariffs. So you have to go back to April last year when President Trump introduced the tariffs, the extreme tariffs for the US. That shocked the US economy. It created a huge amount of uncertainty. It was obviously designed to it was designed to do the opposite, right? The idea was you would protect US industry through these higher tariffs that would encourage domestic consumers to buy locally produced goods. That was supposed to then boost industrial production or boost manufacturing, and that would then re-energize key parts of the US economy. So the idea with the tariffs was to make the US economy stronger, make America great again. That concept of improving industrial activity and adding a lot more jobs within manufacturing. Unfortunately, that's not what has happened. In fact, quite the opposite has happened. The tariffs have created a huge amount of uncertainty. That uncertainty has led to a wait-and-see approach by many businesses, including manufacturers, and they've become very reluctant to add jobs, very reluctant to invest and expand, because they're just unsure about where the tariffs are going and how long they'll be in place. And so confidence levels have declined. And the net result for US manufacturing employment is that since Trump's been elected, there's been only 1 month in which they've added jobs. So this is US manufacturing, and I've purposely just chosen a short time period from when Trump was elected, and you can see pretty much almost every month they've lost jobs. And in total over that time period, they've lost 120,000 jobs in manufacturing. And that's put the US economy under a bit of pressure. There have been other areas where they've also lost jobs. Doesn't mean every sector's lost jobs. Some areas they've gained, particularly in the healthcare sector. They've added a lot of jobs in healthcare. But the planned impact of the tariffs, that hasn't materialized. Quite the opposite. And so it's put, unfortunately, the US economy under some pressure. As I say, that pressure is not a recession. That pressure is simply lower economic growth. Now, of course, you've got an Iran issue, which is driving up fuel prices, which will put the US economy under more pressure. Again, not a recession, but it does weaken the economic backdrop, if you like. So there have been some other implications of the tariffs I just want to highlight. One is the US now imports quite a lot less from China. So if you look at this is just in value, dollars, billions. How much does the US import from China every month? And in purple, I've just put the time period since Trump was elected. And you can see that pretty much every month is lower than where it was before Trump was elected. So on that basis, you might say, well, the US is importing a lot less from China. This is working. The tariffs are having the desired impact. Unfortunately, what that analysis then misses is that the US is importing from other countries much more than they used to. So let me give an example. And a good example would be Vietnam. So you can see the ramp up in imports from the US, or the US importing from Vietnam, and it corresponds with that exact same time period. So what's going on? What's going on is that goods are being shipped from China to Vietnam. When they get to Vietnam, the label changes, it says made in Vietnam, and then it gets shipped to the US. And so you're doing that in order to try and circumvent the tariff impact. So in a sense, you're not achieving anything here. All you're doing is you add in a cost because the goods have to go through Vietnam to get to the US, and you add in a time delay to the process. And we see similar trends with other countries, not just Vietnam. There's other countries in the region that China would use as a conduit for their trade. So you're still importing Chinese goods, just you're doing it under the disguise of coming from another country. And so I don't think that's necessarily what you actually wanted to achieve. The other impact is that it's costing you a lot more as a US citizen or as a US company because the tariffs are much higher, right? And so the US government is collecting, instead of collecting $8 billion a month, they're collecting 30 billion. And so somebody's got to pay this additional revenue, and that has to be paid by either the company who's importing or by the customer, the consumer, the end user. And what that does is it creates price pressure. It creates an element of inflation within the US economy. And there's no doubt that this has stopped inflation moving down to the target of 2%. And therefore, it has stopped further reductions in US interest rates. So I think it's had a negative effect on interest rates. I think it's had a negative effect on inflation. I think it's had a negative effect on the cost of importing and the delay. And I think it's had a negative effect on general economic activity in the US. So I don't see much upside to the tariff initiative. Subsequent to all of this, the US Supreme Court ruled that the tariffs, the liberation tariffs, were illegal. At the time, it was said that they were illegal. Obviously, Trump ignored that and went ahead with the tariffs. But the advice at the time was they're illegal. And then it takes a long time to get this through the court system. So the US Supreme Court ruled it's illegal, and so those tariffs have had to be scrapped. All the Liberation Day tariffs have scrapped. And in its place, Trump put on a tariff of 10% on everything. But he can only keep that in place for 100, I think it's 150 days. And then that tariff will end. And what Trump has said is in the meantime, they'll work out how they can get the tariff back to the level they had previously. So the Trump administration is adamant that they want to have these higher tariffs. My argument is that all of the data that we see suggests it's creating more damage, more harm than good, and I think they would do well to simply get rid of it entirely. Now, on top of that, you've got the oil price, right? So you attack Iran, you blow up parts of Iran. I see in the news that the US is claiming they've hit over 10,000 targets within Iran. So that has inflicted quite a lot of damage, but clearly not enough damage to completely destabilize Iran, and Iran's military remains somewhat effective. They're certainly not as effective as they were, but they have a degree of effectiveness in terms of drones and missiles. And clearly that's put upward pressure on the oil price. The oil price I see today is back up, Brent above $100. And it's pushed up US fuel prices. The gasoline prices moved up, so they have now got an increase that is approaching 25% year on year. Their prices adjust on a daily basis because it's a market-driven price, and it does vary a bit around the country depending on where you live. There's quite a big difference. But generally, prices have moved up considerably, and obviously this will now feed into the inflation numbers. And then depending on if the crisis in Iran gets worse, it could well then feed more. So we don't know entirely where this goes from here because you've got to make a guess about the war. You're trying to predict a war. And given that Trump, I think, doesn't know when the war ends, it's very difficult to predict it. We tend to not try and predict it. What we do is we use scenarios. So we say to ourselves, if the war ends quite soon, as in the next couple of weeks, what do we think the implications are? And I'll show you what that looks like for US inflation. But then we have other scenarios, which then says, what happens if the war carries on for 6 months, the war carries on for a couple of years? What do we think that means? So that's how we tend to deal with it. And we look at each scenario and decide, well, which one do we think is the most likely? So in terms of the inflation forecast, this is now, think of it as our base case, as our best guess, which means that US inflation goes up from here, gets above 3%. Remember, their target is 2%. They never got down to the target. That delayed the interest rate cuts. It's going to go higher. And then, unfortunately, it's going to stay quite a bit above target for some time. And please, this forecast assumes that the war comes to an end within the next few weeks. There's some sort of ceasefire. There's some sort of, okay, we've had enough. That doesn't mean you have to have a full agreement, but that the US at least decides to end their hostilities in that region. And we hope that then Iran follows on the back of that, and the whole area quietens down. It wouldn't be a great outcome in terms of a deal done where all parties are fully on board. I think that's, at this stage, very unlikely. But you can have some sort of easing of hostilities and a pullback of the US military operation. So that's what we've used to put into this. But having said that, we do know that the US has sent about 3,500 Marines to the region. The reports suggest that those Marines start to arrive there tomorrow. And clearly, if you send in 3,500 Marines to the region, you are doing that in preparation for possible a ground operation. In other words, put in military personnel in Iran. On top of that, the US has sent about 3,000 paratroopers from the 82nd Airborne Unit. I think it's the 82nd Parachute Regiment. I'm not sure. It's about one of their battalions. And they have a kind of a force within the 82nd Airborne of about 3,000 that can be deployed within 18 hours anywhere in the world. So think of it as a kind of 3,000 people who are very well trained and very capable, and they keep that as a military force that can be deployed very quickly to any part of the world to deal with any military operation. And that's obviously over and above their special forces. So they've deployed 3,000. And again, that then says that while people keep hoping, like this chart, that the war ends within the next few weeks, if you look at the movement of ground troops, that says, no, that is not a good scenario. And you've got to look at a scenario where the US puts military personnel in Iran. They would have, at this stage, two key objectives. The one objective is to open the Strait of Hormuz by using on-the-ground military activity. Exactly how you do that, I don't know. I think it's not easy, and it may not be achievable, but that would be one of the objectives. The second objective would be to take control of Karg Island. Karg Island is in the Persian Gulf. It belongs to Iran, and it's an island where Iran distributes all of their oil. So they have all these pipelines that go into eventually Karg Island, and ships pull up at this island and get filled up with oil, and then they move through the Persian Gulf, through the Strait of Hormuz, and then they go to other countries. So if you capture that island, Karg Island, then you would control all of Iran's oil distribution. So that would be a very obvious target. And do I think the US could do that? Yes. I think the US military operation in the region could take over Karg Island. We do know that Iran has fortified Karg Island in the last few days in preparation for some sort of military action. I just don't think that that fortification would be enough. So I would assume that the US would take control of Karg Island and then control Iran's oil distribution. And then I assume that their thinking is to use that as leverage to get Iran to open the Strait of Hormuz. We don't think that if the US has a ground operation that they would go into Tehran. We think they would avoid that. That gets messy, and now you enter a long-term protracted war. So that's not our thinking. Our thinking is Karg Island and the Strait of Hormuz. So who knows? You got to watch the developments within the coming days, coming week. I think the thing will either settle down or escalate fairly quickly. We'll know what that solution is, partly because it's just cost you a fortune to keep 6,000 troops within that region. You can't just do that indefinitely. So we'll know the outcome of that. But at this stage, these sorts of numbers are using an assumption that the war ends within the next few weeks. We remain optimistic. Then just lastly on this war, there's a bizarre positive outcome of the war for the US, and that is when you blow up small countries, you boost your economy. How much do you boost? So if you go back to the war in Iraq, the US economy prospered by 0.4% in terms of GDP. So to put that in context, you grow in your economy, let's say at 2%, you blow up Iraq, you're growing at 2.4%. That's what it means. Similar when you blew up Afghanistan. And there's no doubt that the latest action in Iran will reveal itself in terms of a positive boost to GDP. It's not the most efficient use of resources. It is highly inefficient, but it has that spin-off effect, which is quite bizarre, but it's one of the consequences. The US generally, though, people say, oh, the US is going to war because they want to boost their economy. I think that's always false. I don't think the US does that, but it is a byproduct, given that the US manufactures most of their military equipment. The US Army has asked for $200 billion more in military budget. At the moment, they spend in a year just short of $1 trillion. So if you said, what is the US military spend? It is approaching $1 trillion a year, and they've asked for 200 billion more. And there's no army in the world that spends anything close to that, not even remotely close to that. It's just a phenomenal number. All right, so let's turn our attention to South Africa. The South African growth remains the problem. The story remains the same. The story is, how do we get the growth rate stronger? On the screen, I put up a chart of the government's latest GDP forecast. This came out in the February budget. And what it says is that in 3 years' time, the government believes the South African economy will grow at 2%. Now, obviously, 2% is better than 1%, but 2% is hopelessly too low because the population grows rapidly in South Africa, 1.4%. We need to add 600,000 jobs a year. 2% won't do it. And so we really need to get this growth rate above 3%. And ideally, we need to get it up at 4% and then keep it there. And obviously, that's the task. Can we achieve that? Is it achievable? Yes. Could we get it right? Yes. Have we done things? Have we put things in place to achieve that? Yes. Do I think it's possible to get there? Yes. Do I think we're going to get there within the next year or two? No, it's going to take longer than that. But I do think we're making progress in the right direction. So 2% is better than we were, but it's nowhere near enough. We need to get way more ambitious than that. And it worries me that government, with all of their knowledge about some of these developments, still is only got growth sitting below 2%. So where do we get the growth that we do have? What do we do that gives us some growth? We go shopping. The shopping in the last year has been spectacular. So we've done really well. Last year, we grew shopping at 3.7%. And if you think the economy grew at 1.1%, so GDP growing at 1%, shopping growing at 3.7%. That's a massive difference. So we really excel at shopping. Where did we get the money from? Well, we got part of the money we got from the two-pot withdrawal. Not a great way to go shopping, but that's what we did. We got some of the money from credit. We got some of the money from salaries because inflation's coming down. That helps us. So a little bit of everything. And we did really well with shopping, right? The problem, as I keep saying, is you can't shop your way to success in South Africa because a huge percentage of this is imported. We import, except for food. Food, we make a lot of it locally. But everything else, there's a tendency to have a very high import content, mainly from China and other countries. And so we don't get the full benefit of this type of shopping. Now, many people should be saying to themselves, geez, shopping at 3.7%, how did we afford that? And the way to understand that is to look at our savings level. So what percentage of our disposable income are we saving in South Africa? And I want to show you that number. And that number's gone negative. Actually, quite a lot negative. So what does that mean? How does the number go negative? It can only go negative if you spend more than you earn, which means you're living beyond your means. Now, that happens in every society for a segment of the population. Young people they want stuff, their income is not great, they're using their credit card, and they shop more than they earn, and then they end up with some debt, and some people go too far and get into trouble. Or all of that happens in every economy. The problem with this number is this represents the entire country. This is not, a small section of the population is living beyond their means. This is the entire consumer base is living beyond its means, which takes some doing. This is impressive shopping, but in the background, it's suggesting we're getting ourselves into financial difficulty. So it's not sustainable. We can't just keep doing this, right? As much as it sounds wonderful to keep shopping at a growth rate of 3.7%, we can't do it unless we create jobs, unless we create other forms of income. So it was good for us last year. It helped us, but we can't keep doing it. So what is it that we should be doing that we're not doing? I want to show you a couple of things. The first is we should be doing mining exploration, and we're not. In the last 10 years, mining exploration has declined by 56%. That's terrible. So you can't really expand your mining sector unless you are looking for more mining deposits. And this number has dwindled over time. So there's very, very little new developments within the mining industry. There's no new mines being built. There's very little expansion of existing mines. Not a great outcome. On top of that, look at the construction sector. The construction sector in South Africa has had 9 consecutive years of recession. That's massive. The industry has declined for 9 years. The total decline is 35%. So yes, the economy is growing at 1% because we're shopping. But what we're not doing is we're not building. And when you build something, every time you build something, you're building for the future. Think about it. You build a road for the future. You build a hospital for the future. And so what it ends up telling us is we're consuming for today, but we're not building for tomorrow. And that mix is terrible if you want to be prosperous. If you want to just have a good time, fine. But if you want to be prosperous in the future, you have to build for the future. And we're just not doing that. And yes, government keeps talking about all of these investment plans, but a lot of that is just talk. The question is, are you translating that into real activity? And this chart would tell you no, and it needs to change. If you want South Africa to be successful, this number has to be not just positive, it's got to be significantly positive. Look at housing plans passed. So this is where people submit plans and want to build a house or expand a house. So this would include house alterations. This is at the lowest level in decades. And we've got a massive housing shortage. So these are the types of numbers that should be a lot stronger. Construction, building, mining exploration, all of that speaks to fixed investment. And in order for South Africa to be prosperous, that element of the economy needs to turn around considerably. So what is it that we need to achieve? Well, if you look at first look at the blue line, that's the developed world. They spend just over 20% every year. They spend over 20% of their national income on building for the future, on investment. Investment is always for the future. So that's not massive, but it's a meaningful portion of their economy. So what does the developed world spend this money on? If you go to Belgium, I've just picked Belgium at the moment. You go to Belgium, they've got all the roads they need. They've got the railway system they need. They've got the hospitals they need. Their population doesn't grow. So what are they spending 20% of their money doing? They spend that money maintaining the infrastructure, maintenance. They spend the money on, if there's new technology, they upgrade the systems. So they make sure that the system they've got in place functions every year appropriately. And in order to do that, they've got to spend 20% of their national income making sure that happens. The purple line is the emerging market world. South Africa is an emerging market, and they spend at the moment over 30% of their money building stuff. And why do they spend more? Because they don't have stuff, right? They need more roads, more hospitals, more schools, more of everything. And so emerging markets have to spend more because they've got to maintain what they've got and then build more stuff. And so emerging markets, if you said to me, because they spending all of this money building, how fast do their economies grow? This year, we're looking at 4.2% growth, average. That's the average for emerging markets. Eh? That's not the best. That's just the average, 4.2%. Developed markets grow typically at 2.5%. They grow less because they're not investing as much. Where's South Africa? If we put South Africa on this chart, where do we end up? We've dropped below 15%. So what's wrong with 15%? Well, when you're at 15%, you're not spending enough to maintain what you've got. That's the problem. And so year by year, if you don't spend the 20%, things decay, things break. That's why if you go out in South Africa and you look around, you'll see, oh, the water's broken, the potholes have increased, the road repair is not good, the railway system's not working, electricity is a problem. All of these things are problems for one simple reason. You're not spending enough to maintain what you've got, let alone build more capacity. And South Africa desperately needs more capacity. So if you say, well, no, South Africa, we've got to grow this economy at 4%. How do we do it? Very simple. Go build stuff. Don't go shopping. I'm not saying don't shop. We have to shop. Please keep shopping. But it's not about we need more shopping. No, keep shopping, but then build more stuff. And it's the building the stuff that makes the key difference to every economy. And so if you said to me, if we take this fixed investment from 15% to 20%, what happens? South Africa will grow at over 4% GDP. How do I know that? Well, I know that because if you go back to 2006, 2007, 2008, we got the fixed investment over 20%. In those 3 years, each year, South Africa grew the economy by more than 5%. We added 500,000 jobs or more than 500,000 jobs a year by doing that. So we've done this in the recent past. Obviously, at the time, we were building for the Soccer World Cup. That doesn't mean we need another Soccer World Cup. But what it tells us is that you've got to go build stuff, just not stadiums. So build stuff that we need. Build a railway, build more power stations, build water plants, build the stuff, and the economy will grow. You'll add jobs. And then those people who've got new jobs, they can increase shopping. And then everybody benefits, right? So that's what we've got to do. Now, government's aware of this, finally. They worked it out. The problem for government is they don't have the money, right? So you say to government, build this stuff, and we don't have money because we've got too much debt and we're trying to be disciplined, etc. So we've got to then realize, oh, we've got to partner with the private sector. And so that's why we keep talking about the private sector partnership, because it's the only solution that's possible. Fortunately, the positive is that there's now good developments. Look at energy. It's now up at 17,000 megawatts, private sector renewable energy projects. A power station is 6,000 megawatts, typically in South Africa. This is 3 big power stations we've put in place, driven by the corporate sector. Last year alone, 600 companies initiated renewable energy projects. And if I look at the NERSA website, more companies are adding projects every month. This isn't stopped. So don't think of this, oh, we built it and that's the end. No, more companies are adding more solar plants. And how did this happen? It's happened because government deregulated, government changed the rules, government said we will allow the private sector to invest in the energy space, and the private sector said, thank you very much. Now the government is working on expanding the transmission lines. You're going to see that being announced this year. And we're going to be using the private sector to build more transmission capacity. It's going to cost a fortune, but there's a realization we've got to do that. And so private sector is going to be appointed to develop the transmission capacity. Please watch for that later this year. We've also got good initiatives in rail. Look at what happened to our rail. We got to look at the chart, 220 million tons of goods being transported on our rail, and then that collapsed to 140 million tons. Government saying, no, you can't do that because all of those goods went onto a truck, which went onto the road, which has destroyed the roads. So how do we rectify the rail system? Well, we appointed private sector operators. The government has appointed 11 operators. They tell us 7 of them will be functional in the first quarter next year. On top of that, a company called Traction, which is a private sector South African company. They're the biggest rail operator in Africa. They spent 3.4 billion buying 46 locomotives and 920 wagons from New Zealand. Why New Zealand? Because those locomotives fit South Africa, and those things will arrive in June and July this year. That deal is done. That's not, oh, we maybe possibly will be doing this deal. The way we maybe possibly will be spending, building high-speed rail. No, this deal's done. The locomotives are going to arrive in June and July. They're going to get spray painted, and then they'll be used by the private sector to help re-energize the rail system. So that's a very positive development. And I'm expecting more will be added to this as we go into next year and beyond. And then the third key development is we finally signed the contract with the Philippines company. It's been years. This has taken 3 years. But the Philippines company signed a deal, a 25-year contract to run Pier 2 Harbor, which is the container port within Durban Harbor. It's the biggest container port in South Africa. It's critical to our imports and the efficiency of distribution of goods. The Philippines company runs 34 ports around the world, and they signed a 25-year contract. They own 49% of Pier 2. Government owns 51%. They're going to invest a huge amount in upgrading the port capacity. And I've got no doubt that in time, this will add to the efficiency of Durban Harbour. And what Barbara Creasy as the Minister of Transport has said is, if this works, we're going to do it for other ports. So these developments are critical for us, right? Because they are clear examples of government realizing we need to invest, we need to build stuff, we need infrastructure, we don't have the money, we have to partner with the private sector. And that process is underway with many more projects in the background. I only want to focus on things that have actually been announced that are happening. But if I listen to the meetings I'm in, there's lots that's been worked on. So I'm optimistic in a year's time, there'll be more stuff being added. So all of that's good. Where's the negative? The negative is the damn oil price. So let me show you what our problem right now is. Our problem now is a petrol price that is likely to go up 6 Rand, 6.50 a litre. That's a monster increase. That excludes the fuel levy. I'm hoping the government will decide to postpone the fuel levy hike. They can't do it indefinitely, maybe about 2-3 months. But we're looking at 6 Rand, 6.50 a litre. That's a monster increase, right? And then that's the good news. The bad news is the diesel price. We're looking at an 11 Rand increase in the diesel price. That's huge. And obviously, as that increase comes through, it's going to hit consumers, it's going to hit business, and then we're going to be worried about, okay, so what does that mean for inflation? The petrol price going up means inflation goes up. So we're going to take inflation from 3% to over 4.5% in 1 month. The target's 3%. We're patting ourselves on the back. We've achieved the target. It's going to go over 4.5%. And then the longer the war continues, the more this becomes problematic, because it's not just a short-term shock. It can become an embedded shock, which then adds to our woes. So, geez, this is coming along at exactly the wrong time for South Africa. So let me show you the implications of this for inflation. And again, I'm using an assumption that the war ends within the next few weeks. So let's look at what the inflation forecast was before the war started. This is what we were looking at. And remember, we've got a target of 3%. This is a beautiful chart. The inflation rate came down to 3%. And look at the forecast. The forecast said we're able to keep this under control. So what did that mean? It meant we expected the Reserve Bank to cut interest rates twice this year, and we expected them to cut the interest rate twice next year. That's 100 basis points down. That's a full 1% expectation of interest rate cuts, because we're pretty much achieving the new inflation target. That is what we were looking at. And then the war happened outside of our control. And because the wars happened, now we're looking at this as our scenario. And this is the best news. This is the good news scenario. So what happens if the war becomes extended? What happens is the numbers go up, as I've got in the chart, and then they just struggle to come down. And what does that mean? You now start to talk about interest rate hikes. I don't think it happens in the short term. The Reserve Bank will adopt a wait-and-see approach, rightfully so. They'll say, this is a shock. We were going to cut rates, but we can't. This is a shock. We need to put interest rates on hold, and we need to watch how things develop. But clearly, if it becomes worse and worse and the oil price stays high, then they're going to worry about what that means for broader inflation, and they'll put up interest rates. And people will say things like, but how can they put up interest rates? That's not going to bring down the oil price. That's not going to bring down the petrol price. And it won't. It won't. It's not designed to do that. But the Reserve Bank has to worry that if the oil price and the petrol price goes up, then a whole range of other prices will go up. And they will worry that consumers will use their credit cards to fill up their tank and keep buying the same amount. And that will just fuel more inflation. And they want to achieve their 3% inflation target. And so the longer this carries on, the more they'll be forced to consider hiking rates. So unfortunately, we are in a good space, I must say. The developments, let's ignore the Iran war. Geez, we were moving into a much better space. Government finance being managed well, inflation under control, looking for interest rate cuts, looking for another credit rating upgrade later this year. All of that, good news. Clear evidence of private-public partnerships, good news. We were starting to get foreign money into South Africa. Excellent. Now we have to deal with this shock. I'm hoping the shock is short-lived so we can get back to our better journey. But we've got to be realistic. If this thing turns worse and the war is extended and the oil price stays where it is or goes higher, then it's going to cause more damage. I know that's bad news, but that's our reality. That's all I'm going to ramble on about. I'm worried about time. I don't want to take Rico's time. I don't know if there are any questions, Corday, if anybody wants to ask anything.
Yeah, Kevin, for now, there's no questions in the chat, but yeah, thanks for putting us in the loop and how things are playing out and the updates. So certainly there is positive things in South Africa. I mean,
Yeah,
clearly we can see that the private public sector is not public, the private sector is contributing to a meaningful way, and things are
yeah,
happening. I mean, we've been waiting for this for literally decades.
yeah,
So that's good news. It's just unfortunate where we are at this point in time. So naturally, this Middle East conflict is a curveball, I think, for the rest of the world, and I guess we need to wait and see how this is going to play out. I do think the positive thing that we do have is that we do have an extremely conservative SARB. And Letsetja Kganyago, I think, is doing a sterling job on trying to keep a lid on things and not let his emotions and whatever's happening in the world run away from us. So I think that might probably help a little bit.
yeah.
And the independence of the SARB, there's no issues there that we need to worry about there.
No, no. Lesetja is highly independent and cherishes that. He'll fight for that independence. And I think the Minister of Finance fully understands that and accepts that. There will be questions when when the petrol price goes up for government to provide assistance. There are not many options. The reason is, I mean, they can delay the fuel levy a couple of months, but beyond that, it just becomes too expensive. These numbers are enormous when you start to say, government is going to subsidize the petrol price, or government must get rid of the fuel levy tax. That sounds great, but it generates a lot of revenue for the government. And if you do that, now you go from fiscal discipline and a credit rating upgrade into, ooh, now you've got even more debt, and now you're not going to get the credit rating, and you're undoing a lot of the positive you put in place. And I just don't think the government's going to want to do that. So unfortunately, there's not a lot that we can do about this oil price shock. I'd love to tell you we can do this, this, but everything. If we try and do something, there's a cost, and that's a political decision. But I think at this stage, I think we just got to work on the assumption that these are the price effects we're going to end up with.
Yeah, so Kevin, I must say it is a bit of a scary thought to think about the fact that if this is going to be not necessarily a prolonged conflict, but I mean, if oil price is going to remain high, what the long-term impact that might have on us as a country. I mean, that is fairly scary at this point in time, and I do think it can have serious ramifications and
Yes.
long-term
So
effects
let's
on
say
us. So,
that this lasts for the let's say it lasts for the remainder of the year, where you've got an oil price above $100 a barrel. Now, instead of saying, "Oh, I'm looking for, 1.6% growth, 1.8," now you're marking growth down closer to 1% or even slightly below that, because the petrol price increase is worse than a tax. If I'm government and I increase your taxes, you're not going to be happy. But the advantage is that government's now got your money, and potentially they could do something with your money which would add to the country, right? But with a petrol price increase, it's effectively, I'm taking your money, giving you the same amount of petrol. You're no better off. You've got the same amount of petrol. I'm taking your money and I'm sending your money overseas to somebody. There's no benefit. So it's worse than a tax. And if you do that for 1 month, the country can absorb it. We're not happy. Do it for 2 months. Okay. You do that for a year. That's a lot of income you've lost. That starts to have a negative effect on your growth rate, which then ends up with the economy slowing rather than what we thought it was going to do is accelerate. That's the problem.
no, I know I'm almost going to finish up here, but yeah, I think the one big thing that people are quick to forget is the fertilizer
Yes.
issue, in the sense that that's also going to increase a lot, and that's going to increase a lot of food inflation.
Yes.
And the petrol inflation or diesel is going to just make that a lot worse. But yeah, so it's not looking great if the war is to continue for long term. I've got one last question for you, Kevin, and that's we've heard again from all the economists out there like yourselves over the past couple of years that what we need to do to fix the country. It's
Yeah.
almost like everyone knows what we must do to fix the country, but just doesn't seem like that government knows it, or is doing it. Do you, as an economist, and all the rest of the economists, do you have a forum where you actually get to meet with government and tell them what you are telling us, and show them the numbers, and try to convince them of what to do, and what not to do?
So the answer is yes, we do. But yes, but so so where we meet with government is in three main areas. The one is we meet with the Reserve Bank a lot, but that's not government. That's truly independent. But there's a lot of discussion with the Reserve Bank. We meet with National Treasury a lot. We have workshops with them, and we would discuss, and they ask us. In other words, they purposely set up a workshop with private sector economists to say, "Come and tell us what your thinking is," etc. And we would convey all of the same message to them. And at this stage, National Treasury would not disagree. It's not like National Treasury sitting there saying, "No, we don't know what you're talking about. This doesn't make any sense." They would fully agree with those views. And then we discuss a lot with Rudy Dix and his team, which sits in the office of the presidency. So that's Operation Vulindlela, and they are tasked with a lot of these reform initiatives, the private-public partnership reforms and other reforms. And there's a lot of engagements. And we would, for example, invite Rudy Dix to come and talk to us in our investment meetings, and we can have a debate with him and tell him our views, and he's very receptive to all of that. So that discussion happens. What doesn't happen is we don't meet with the Department of Education. We don't meet with the Department of Healthcare. We don't meet with every government department. We meet with those three entities, and we know that government is much broader than those three entities. And so it does feel to us that we're talking to people who already know this and are in agreement with this, but they themselves have a high level of frustration in trying to get this all implemented. So if you meet with National Treasury, you will hear a huge amount of frustration from National Treasury that they themselves are struggling to implement the correct measures within government departments, to make sure government doesn't waste money, to make sure government spends the money on infrastructure, to make sure that municipality. An example would be, right, silly example, but listen to Enoch, the Minister of Finance, talking about Johannesburg after the budget, at the budget breakfast. You go to the budget breakfast and you're talking to Enoch about Johannesburg, and you're thinking, what is he saying? He is scathing of Johannesburg, telling us that National Treasury is going to have to get involved day to day in the way in which Johannesburg is managed. That is him being very critical of the biggest city in South Africa being mismanaged. That's frustration from within Treasury. So when you say talk to government, yeah, but it doesn't mean that all of that permeates into an improvement, because the people we talk to kind of already know this, buy into it, and they want similar things implemented. It just takes the bureaucracy is extreme. It takes a long time to make this stuff happen.
Yeah, so I totally agree with that. It's so difficult, but I think the elephant in the room, and it's a question from the audience, is basically where's all the money? So why do we not mention that money to maintain and build is being stolen? And that is the biggest threat to any form of growth and a
Yes.
sustainable economy.
Yeah, so you're right, 100%. So it's worse than the numbers I'm suggesting, because remember what I'm doing is showing you how much is being allocated. Now, that doesn't talk to the efficiency of spending. There's a big difference between I spend X amount repairing a road, but how well did I repair the road? The numbers can't tell you that. And we know that a lot of road repairs are quickly, the road is back in the terrible condition and so on. So, yeah, 100%. It's not just about spending the money. It's about spending the money wisely.
Cool.
And so the last workshop I had with National Treasury was about exactly that topic. The topic was, it's one thing to control the spending, discipline, but it's a whole different ball game to make sure that what money is spent appropriately, is spent efficiently. And that is even more frustrating. So yeah, I agree with you.
Cool.
It's an uphill battle.